Welcome to the Empowered Investor Podcast, brought to you by the advisory team at Toulette, Matthews and Associates. Have you ever felt overwhelmed by the number of voices telling you how to plan or invest for your future? We're here to help you cut through the noise, bringing clarity to your investment decisions and helping you build lasting financial peace of mind. Learn more and subscribe today at tma-invest.com. Welcome to the Empowered Investor. My name is Keith Matthews, and I'm joined by my colleague, Lawrence Greenberg. Lawrence, welcome to today's episode.
Thanks for having me. I'm glad to be back on the show.
We've got a great show today. We're going to be doing the 2025 year in review, as well as how do you prepare yourself for 2026. So in today's show, we're going to cover off the asset class returns for 2025. We're going to highlight some of our portfolio returns. We're going to go into some of the main themes that we saw in 2025, the main investment themes. Some of them included rotation. Different areas of the market did way better than one might expect. We'll review sort of 5-year themes as well. We'll take a deep dive in a conversation around AI, revolution or bubble, just try to add some perspective in terms of how one invests through this. And then finally, we'll come up with a series of strategies and thoughts around how to think about going into 2026.
Yeah.
So Lawrence, lots of work here. You just finished writing our firm's commentary, which went out to all of our clients. You did an amazing job. Thank you for doing that. All right, Lawrence, let's jump right in. Set the stage for us. How did we get through 2025? What did it feel like?
Well, it didn't necessarily always feel good for investors, and I think that's an important takeaway here is it was a year filled with volatility. So we found ourselves plugging along at the start of 2025, and then in the spring, Trump announced tariffs, sweeping tariffs globally, and stock markets reacted quite negatively to that. Stocks were down 15, maybe even 18% at the low, happened within 3 days. So 3 consecutive days of really negative returns, and the outlook looked very negative. There was a lot of uncertainty. And on a dime, these tariffs were starting to be tailed back a little bit. There was more dialogue, and markets looked towards the future a little more optimistically, and stocks really skyrocketed very shortly after. I mean, we had a couple consecutive days of 5, 6, 7%, and then we end the year with exceptional, highly above average returns.
Yeah, it was a very peculiar year on many fronts, because if you think about it, the first 3 months, every Canadian was walking around, first of all, the Canadian election, which was dominated by sort of this theme of Donald Trump and U.S. tariffs. And Canadians it was heavy. You could feel it. You could feel it with people's conversations. And so those periods, I remember being in a car one day and I wasn't driving and checking my phone, but I just got into my car, I checked my phone quickly, and the market was up 7%. And this would have been a couple of days after
Liberation Day.
Yes.
Yeah.
And so the irony I found of 2025 was that just about on the tariff front, every area of the world that the U.S. picked on had outstanding investment results.
Where the U.S. also lagged, relatively speaking.
Yeah, so that's kind of a bit counterintuitive. You know, individuals don't think that way. So the United States came out, put through the tariffs on Europe, on Canada, on all these areas, and all of those stock markets did exceptionally well. And whereas the U.S. probably had one of its biggest lagging years we've seen in a long time.
Yeah, absolutely.
So that was a very peculiar event throughout last year.
Yeah. So there was a time where people wanted to take risk off the table and make decisions and try to predict. And, it was virtually impossible to do so. We just ran the numbers, and from the very bottom in early April to the end of the year, your performance from that bottom was almost 35% globally. So you're down 15% from that point onward. So if you stayed invested or you added money during this time of volatility, you did quite well.
Yeah, fair enough. That's excellent. Let's jump into the specific asset class returns. Just walk us through major asset classes around the world and how they did in Canadian dollar terms.
Yeah, so how did markets do? So Canadian stocks were up 32%, U.S. stocks up 13%, international stocks up 25%, emerging markets up almost 28%. Global bonds kind of plugged along at 3%, and global real estate REITs were up almost 3%.
So these are extraordinarily powerful, strong numbers in the equity market, in particular because they've happened a couple of years in a row. I know what we've got a stat saying that from the beginning of 2023, so Jan 23, so 23, 24, 25, MSCI All Country World Index appreciated 75%.
Yeah.
So those are very strong numbers.
Yeah, you almost doubled your money in 3 years here.
Yeah. And the other thing that I found interesting is that every asset class was positive.
Yes.
So there wasn't really a big negative in any area. So this is another year where bonds did well, real estate investment trusts kind of plugged along. No great strong numbers there, but still nonetheless positive. And then U.S. stocks across the board were super positive.
Yeah, and as we were alluding to, so U.S. was up 13, while Canada was up 32%, and international stocks were generally above, 25 to 27%. So international did quite well, and U.S., who was dictating the geopolitics and the global order, lagged, relatively speaking, still, 13%. But this is in contrast quite starkly to what the past several years looked like, where the constant theme in investing was U.S. exceptionalism, was why invest anywhere but the U.S. because they're so strong and so dominant from an economic standpoint and a market standpoint. And it would even surprise investors that over the last 5 years, the S&P 500 and Canadian stocks virtually have the same return. So people were so infatuated with the S&P 500, Canadian stocks have been right there with it at about 16% per year for 5 years.
Well, so yeah, and this is all based on this incredibly powerful resurgence of Canadian stocks and international stocks. It was so powerful that it brought the 5-year number in line with the U.S. And so if we would go back in time, let's say go back to 2021 and then say, we're going to predict this incredible new technology coming, and this is the way it's going to affect, and these technology companies in the S&P are going to do super well. Dear investor, where would you like to invest? Most people would say, I have to be in the S&P 500. And the irony has been that it's actually been just as good to be in Canada.
Better.
And with our strategies, which tilt a little bit more towards some value securities, and they include some small cap, which did extremely well last year, our Canadian equity has surpassed S&P 500 over 5 years by 3, 4, 5%,
which is huge,
annualized, which is unbelievable.
Yeah.
So that's something that most investors just would not have thought about back then, and this is one of the benefits of staying globally diversified. So that rotation that we saw last year, very powerful, very unexpected rotation away from U.S. securities towards Canada, as well as international. There's been a lot of discussion in the last many years that international markets were lagging, were cheap, valuations were very low. And so it was perhaps a matter of time before some things would come through and would pop that market back up. So we saw that last year.
Yeah.
Do you have a sense as to why? I have a sense, my gut feeling. Why do you think that happened?
Well, I think on the Canadian front, it's quite clear with the price of precious metals going up and mining and materials doing quite well, we're seeing that come through in the returns. Also energy and there's some financials. The more boring industries, one might say, which is quite interesting in a world where everyone's talking about AI. On the international side, I'm not quite sure. What do you think?
These are hypothetical theories were coming up, but I think it has a little to do with countries that were pressured, in this case, by the U.S., to rethink their economies and restructure a few things. The marketplace is rewarding those countries for some of that restructuring and for some of the fact that they're realizing, listen, we have to change the way we conduct our economies.
Yeah. Be more independent, maybe.
Be more independent. Start thinking internally. Start exploiting things that come to your country. And I think it's kind of like, it's one of these consequences of being bullied a little bit.
Yeah.
That you're rolling your sleeves up and you're saying, okay, fine, we've got to make this work. And I think stock markets rewarded that activity.
I think that's very fair. Time will tell, but I think a lot of countries and a lot of politicians are thinking about how to move forward in post this regime. But time will tell. But what we've seen thus far is a very nice reminder that staying diversified in terms of having a well-diversified portfolio of countries, but also styles and sectors, owning the overall market has really rewarded investors.
100%. And then nobody could have predicted any of this.
No.
So, this whole idea of trying to figure out where to move to in advance you would not have been able to predict this.
No.
So, okay, let's keep the conversation going. Lawrence, we're going to go to AI. And there's a lot of conversation in the media and in the investment circles of, is AI revolution that has staying power, or has it now become a bubble? And we can't predict. It's not part of our investment philosophy, but we have ways to think about it maybe and ways to reinforce why you stay the path of these globally diversified portfolios. But it is nonetheless interesting just to kind of delve into this a little.
Yeah, so is this a bubble is kind of the multi-trillion-dollar question, and I think anyone who's saying they have the answer, is full of it. But I think we could have a good discussion because there's a lot in the media and popular culture. In the market universe, a lot of people are saying, is this like another, dot-com bust, where there's a new technology, there's a revolution, there's a lot of excitement and infatuation with a certain sector. Again, it's technology. There are some similarities and, there are higher valuations and there's a lot of excitement, but there's also a lot of key differences where these firms that are leading the pack right now are still highly profitable. The valuations are not nearly as exorbitant.
So let me back you up. This is great. What are some of the similarities? And then we'll go into the differences. In theory, in general, what are some of the similarities?
Yeah, some similarities is there's a very narrow view of the market right now as anything but this sector, this AI and technology sector. It's not worth investing in. People are piling into these stocks, and these stocks have had exceptional returns. These stocks being NVIDIA and Google and Microsoft and so on.
Yeah, and I also think one of the other common themes would be, that's excellent. One of the other common themes, I think, would be this idea that this is going to change the world. This technology is going to change the world forever, and it will. But because it's going to change the world forever, you can invest as much as you want and you'll never lose.
Yes.
It's a no-brainer. And to me, that's one of the infatuations that individuals have to be very careful about.
Yeah, it's a very dangerous philosophy here where you assume that what's going on now will inevitably continue. And we don't know who the leaders in AI will be, what other firms will pop up and reshape the industry. This is still a very young technology. We're seeing a lot of investment, right? So that's also one of the parallels between, .com with the fiber optic cables. And now a lot of data centers being built, a lot of infrastructure, billions of dollars being spent, and prices of a lot of these technology companies are very high, pricing in this future growth that may or may not happen. It's important to have a grounded approach and be diversified in a sense where, AI will help plenty of other companies and sectors and industries indirectly by being more efficient and more productive. And it's important to own a good basket of stocks.
Well, this gets back to how do you benefit from AI? And we take the view that investors benefit from AI if it's a revolution, which I believe most people feel strongly that it's going to change the way businesses conduct themselves, the way individuals can work. All companies will benefit.
Exactly.
All companies. So the idea of investing in a company that delivers this technology or a company that benefits from the technology, if you subscribe to the fact that all companies will benefit from the technology, then you should embrace a globally diversified portfolio.
Yeah.
In our world, that means owning 10,000 companies in your portfolio, and all 10,000 companies will benefit from this new technology.
Exactly. Where my mind goes is the story of Cisco, which was the darling of the early 2000s. They were the largest company by market cap at its peak during the dot-com, boom and subsequent bust, obviously, where they were the leader in the internet revolution. They were the ones who were laying the fiber optic cables, who were investing heavily, and the price rose astronomically within a year period, a 2-year period, and then following this bursting of the bubble, lost almost 90% of its value.
Many of our listeners will remember
Yes.
this period. If you're my age category, Lawrence, if you're 62, plus or minus, this is the young boomer, the whole boomer generation will totally remember the Cisco. What's the other big? It's a Canadian stock that dominated the Canadian market. It was like 33% of the TSX. From a valuation perspective. What was that stock?
It's definitely Nortel.
Absolutely.
Yeah.
So Nortel and Cisco did the same thing.
Yeah.
If you were to overlay Nortel, except Nortel went bankrupt.
It went to zero, yeah.
Yeah, and Cisco didn't. How long did it take for Cisco to get way up? Then it crashed 90%.
Yeah.
And this was the largest stock in the world.
From
a capitalization. It crashed 90%. How long did it take to gain back its original value of 25 years ago? Well,
It took 25 years, Keith. It took 25 years to make back your money. So this was the leader. They were, the innovator. They were profitable, and it took 25 years. So your investment thesis could be right. At the time, it was the internet is massive. It's going to revolutionize the world, how we live our lives, the economy, and that was right. But the price you pay for an investment matters. And this was a case of buying a stock that is very expensive, exorbitantly so, And even though it was the right bet, quote unquote, with the internet, it didn't pan out for investors.
Yeah. And then plenty of companies benefited from the internet. So it's a classic story of if an individual is trying to chase one or two of these big winners, it's a cautionary tale here. Mm-hmm. So you mentioned early in the conversation, Lawrence, that there were some dissimilarities between today's period and the period 25 years ago. What are some of these dissimilarities that individuals are highlighting?
Yeah, it's a very good point, Keith. Firstly, is that a lot of the market leaders that have had exceptional returns are still profitable. They're still sound companies that have had years of success, this being Facebook, Amazon, Google, Nvidia, and so on. They are still sound businesses. It's not pure speculation. However, the valuations are relatively expensive.
All right, Lawrence, let's jump into the next section of today's show, talking about how we think about 2026, how we think about going forward. And this is the time of the year where just about every bank, every major investment firm comes out with predictions for future results for the next year. What are your comments about predictions?
Yeah, so it'd be really nice in finance if you could perfectly predict what will happen in the future. Unfortunately, that's not the case. And these firms have the cutting edge technology and all the resources and these experts who try to predict what will happen in the future. Now, we're looking at a nice chart from 2024 where these firms, these experts try to predict that calendar year. So in that year, the S&P 500 was up 23.5%. And I'm looking at all these bar charts of all these firms and where they thought the returns would land. About half of them were positive, about half of them were negative. And I'm looking at Morgan Stanley and JP Morgan. They predicted negative returns, and JP Morgan expected minus 10%. So they were off by almost 35%.
We've been in the business for a long time. We've been talking about ignore predictions since we started this firm.
Yeah.
So it's part of our investment philosophy. We do not believe that any organization can accurately predict even short or long-term investment results. And to try to move a portfolio around based on these types of predictions is impossible and it's dangerous. I'm looking down the list here, and one of the major Canadian banks whose slogan is "You're richer than you think" had a negative expectation that year, and so they would have been off 30%. Like that's a big number to be off.
So if you followed that prediction, you left 30% off the table.
So if you're a client of that bank, and that's what that prediction is saying, and you moved your portfolio based on the research team of the bank, you're not a happy camper.
Yeah.
You're actually not richer than you.
Yeah, exactly.
The other thing that I would raise is that these are short-term predictions, sort of 1 year. I mean, for me personally, one of the most famous long-term predictions I remember was Bill Gross, who managed PIMCO. He was probably 15 years ago the absolute top bond manager in the world. He was considered a superstar. He was overseeing, back in the day, something to the extent of $300-400 billion, which was a lot of money 15 years ago. But he came out around 2010. So go back in time. We just finished a stock market correction. We are about to enter one of the strongest bull markets in the next 10 years.
Yeah.
He predicted absolutely the lowest returns you can imagine. He was such a pessimist on long-term returns. His predictions were you're not going to get more than 1% to 2% returns from stocks as we went into this incredible bull market.
Exactly. Yeah.
But I recall that shaped investors. Anybody reads that
Sure.
says, that's a person I've always respected.
Yeah.
You get caught into these concepts that don't help you.
Yeah, these traps, really. Yeah.
So that's a great little piece on predictions. So now we're going to move forward. So how do we think about investing in 2026? Talk a little bit about valuations, and then I'm going to ask for your takeaways at the end of the show.
Yeah, so obviously we've now had, a very strong 1 year, 3 year, 5 year, and even, 10 year. Since COVID, it's been a pretty much a straight shoot except for 2022. These returns, especially in the last 3 years, have been above long-term averages. So investors have enjoyed that. So well done for those who have stayed invested. However, valuations in a lot of the market, not the whole market, are a little bit stretched now because of this higher performance, higher valuations. Expected returns may be a little more muted.
And expected returns are a calculation based on valuations.
On price today. Yeah.
Yes. And so this is where we get back to prices do matter. It's interesting. I remember back to my 2010-ish period where we just finished the lost decade, and we would sit with client portfolios. The lost decade was a difficult period. You had stock returns coming in at zero.
Yeah. So that was 2000 to 2010.
To 2010,
right? Yeah.
You have stock returns globally average, depending on the month you're looking at, zero. Can you imagine being invested in stocks for 10 years and you get zero?
In U.S. stocks specifically.
No, the U.S. was negative, and just globally across, like you had portfolios, our investment statement said 0% rate of return over a decade. When I look at the 10-year number, the 10-year number for the portfolio, fully equity, is compound 11.4% compound over a decade.
Yeah, that's every year average 11.4.
Well, that's
incredible.
Is unbelievable.
Yeah.
So this is back to your piece on, be grateful, thankful, but they've been super strong returns.
Yeah, and for our 3-year 100% equity portfolio, it's almost 20% per year for 3 years in a row. These are way above average, and that's great. So investors have more money because of it. But on a go-forward basis, you must be grounded in your expectations. This is above average, great. Going forward, we may expect more muted returns.
And there's some groups that are saying, and we're not here to predict, this is why we will always say keep a globally diversified portfolio, but some areas within a portfolio may not do quite as well. So for example, U.S. securities have been touted as one area, mind you, for a few years now, as an area that may have the lowest expected returns.
Because the valuations are higher.
Because the valuations are so high. Okay, Lawrence, so what are your main takeaways and recommendations for investors?
Yeah, so after a really, really strong couple years, a really, really strong year, way above average, I would say that if you've had an investment plan that has been working for you, there's no need to reinvent the wheel. You should stick to your plan, stay invested, not try to predict things, and accept overall stock market returns. We look at the long-term average of global stocks. For the last 100 years, I have this number, it's 9.5%. We've been above that, but you very seldom get that long-term average. You get kind of minus 20, then plus 30, and then 5, and then 2, and then minus 6. And there's a kind of a mess of long-term performance that tends to look nothing like the average. So you have to accept that volatility as the price of admission for investing in stocks.
That reminds us of David Andrews' post this week on LinkedIn. I thought it was a very well-written post, and he called it the price of admission, which is if you want to get these great returns, you have to enter this world where returns are random and almost chaotic and almost counterintuitive. And when you're dealing with uncertainty, you sometimes get the best returns, which is very counterintuitive. So you look at the last, I believe it's the last 70, almost 100 years. 100 years. When I look at the average return in the S&P 500 of, say, 10%, of 100 years, there are only 3 years of 100 where the return is 10% plus or minus that, within 100 basis points, from between 10 and 11%.
Yeah, exactly.
97 years, you're outside of that 10% number. And that was his point. If you want to get those good long-term returns, that's the price of admission, is dealing with the bumps.
Yeah, absolutely. So that's kind of a reminder that even beyond that, even when things feel negative and you think something has to happen, that's not necessarily the case. So I look back at last year. May was an exceptional stock market year. Right after Liberation Day, the month was about, I think it was 7% or something like that, just boom. And it wasn't feeling good for investors at that time. So you have to accept all the chaos and all the volatility and the bumps and expect that every couple years there's some kind of event or correction, but that's how you get the long-term performance.
Yeah, fair enough. Absolutely fantastic takeaways. I really like the 100-year story, Lawrence. I think it's very telling. My final comments would be, like you said, stick to your plan. So make sure you're maintaining your long-term asset allocation. Make sure you're rebalancing back, especially if you're maybe a retiree. Make sure you rebalance back to your long-term mix. Congratulations to all the investors who have stayed with the course. The returns are some of the strongest returns I've ever seen in my career, and they are really phenomenal. So kudos to everybody who's stuck to the plan. Congratulations on that. And Lawrence, thank you so much for today's opening show of the year. We review 2025 and we set expectations and we set up a story for 2026.
Yeah, I think it was a great show.
And to our listeners, we wish you great health and happiness for 2026.
Take care.
Thanks for listening to the Empowered Investor Podcast, brought to you by Matthews and Associates. If you've enjoyed today's episode, be sure to follow or subscribe and share it with somebody who wants to invest with clarity and confidence. To learn more about how we help investors build lasting financial peace of mind, visit us at tma-invest.com. Until next time, stay informed, stay empowered, and stay on track to your financial goals. Investment and investing strategies should be evaluated based on your own objectives. Listeners of this podcast should use their best judgment and consult a financial expert prior to making any investment decisions based on the information found in this podcast.